Welcome to Empowered Returns, a show that surfaces forward-thinking real estate advice that investors and developers need to help them invest smarter and build better.
Welcome to another episode of Empowered Returns. I am PT Vineburgh, founding partner here at CHARLESGATE, and without my co-host Mike DeMello today, but very pleased to welcome Brian Sheehan, principal of Capital Stack Commercial Real Estate Finance. Thanks for coming on here. So let's just kind of jump right into it, kind of talk a little bit about your background in the business and, the path that led you now to principal of your current firm at Capital Stack.
Sure. Yeah. So I started in commercial real estate about 20 years ago. I had a couple other companies before and sold a healthcare company that I had. And while in the process of doing that, I was subleasing some space from an old high school friend who had just started another boutique mortgage banking company. And he invited me to share space at the time. And over the course of 6 to 12 months, while I completed the sale of that healthcare company, he and I sort of got, rekindled our friendship and had a chance to see how one another worked on a daily basis. And by the end of that year period, he invited me to partner with him, which I capitalized on. And then we were partners for about 16, 17 years, which was a great partnership. And so it was really, that was my entree into commercial real estate. And then just kind of learned, on the fly.
Cool. All right. So let's just kind of dial it back one level here and just, obviously we're a design development focused podcast, and, financing and how to structure deals is a big piece of what our audience wants to learn about. So can you just kind of briefly explain like the concept of a capital stack, and then I guess typically sort of what you're seeing in the multifamily space and what size deals, how that varies, on a smaller one compared to a larger one, and kind of just give us a little overview on kind of what you do day in, day out.
Sure. So when somebody's talking about a capital stack, what they're referring to are the layers of capital. Sorry to use the same term to define itself, but the layers of capital that go into a transaction. So it's basically all of your sources to be used to finance a project. So there's going to be, typically there's debt, there's equity, there may be mezzanine debt or pref equity. You may have tax credit equity in there or tax credit bridge debt. And all of those layers together will comprise your full, what's called capital stack. And that's how a project comes together, or whether it's, a ground up project, an acquisition, or even in today's world, we're seeing more frequently structured refis where when I say structured, I mean that it's not just a traditional first mortgage lender that comprises all of that stack on the debt side, but rather we're having to layer in, mezz or pref in addition to that first mortgage in order to avoid a cash in refi from an owner, from a sponsor, which is a new term that really has just popped up in the past year. So,
yeah, that does not have a great ring to it.
No,
I'm sure for our audience, like most people prefer the cash out refi.
Right.
So I guess that's a good segue. Like, so what the heck's going on in the capital markets right now? How have things changed over the past 12 to 18 months as far as what you're seeing, how you're able to put or not put deals together, and just kind of what the climate is, again, in what's been a pretty rapidly evolving space here the past year?
Yeah. In the 20 years I've been doing this, I've never seen anything like this. I think really, if somebody's being honest about experience in a rising interest rate environment like we've seen over the past year, you really have to go back to the 70s. And obviously there aren't too many professionals that are still active in the marketplace today who were professionals at that time. So, it's been almost 50 years since we've seen this. And what's happening is there's a very real credit tightening across all of the markets. So whether you're talking about the different asset classes, and you specifically mentioned multifamily, and I know that's probably where most of your listeners, viewers are going to be more keenly.
Yeah, for sure.
But so in the multifamily space, we're seeing that lenders, like for example, Bank of America last week announced that they are pulling out of all commercial real estate lending for the foreseeable future. that is a huge, obviously, behemoth. And when they make an announcement like that sends shockwaves throughout the industry. Others then panic and kind of hide in corners, right? So lenders in general, bank lenders, excuse me, are pulling back. So B of A is out. Obviously, we've seen the fall of 3 banks in the last 6 weeks now, right? So it started with SVB, Signature Bank, and now First Republic. And I think that the concern, a very real concern, is that others will follow. Rates have risen so fast that banks are upside down in what their liquidity requirements are relative to their assets. And so banks lend. That's what they do. They go long on treasuries. That's what they do. So banks were long on treasuries for years. And then all of a sudden rates spiked and those treasuries are worth a heck of a lot less. They can't liquidate those at this point. Right. So if banks had sort of a capital call, if you will, on themselves, then they're in a world of hurt because their balance sheets are just not where they need to be relative to their liabilities and to their assets. So then on the lending side, I think that, the other thing that's happened historically is that banks would trade their mortgages, right? So
right.
You could always dump off $100 million worth of commercial real estate mortgages, for apartment buildings, let's say. And that was a pretty liquid market. There were plenty of buyers out there. Banks like regional banks here in New England, small banks, were all different sizes, would trade amongst each other fairly freely. And there was always a market for that. But now, if you're sitting on a 10-year fixed rate at 3.5%, $20 million apartment loan that you got into as a bank 2 years ago. But today that same loan would be 6.25%. Then your 3.5% loan is not worth its face value, right? It's no longer worth the 20 million that you're owed.
Right.
And so that's made those mortgages themselves very illiquid. And that's posing a huge problem for banks. So they're being stressed by their regulators. They're being told that they need to increase liquidity. They don't have the ability to sell off their existing mortgages. We had the PPP money run through the banks where they were awash with capital for a long time, had huge deposits. All that has now made its way through the system. So those deposits are gone, but those were in place in the last couple of years leading up to a year ago. That the PPP money was in place in deposit accounts at all these banks, which bolstered their ability to lend yet further.
Right.
So now they're kind of out over their skis in that regard as well. And then lastly, the other issue that they have is that treasuries are reasonably priced from an investment perspective. You can get 5% on your money. So
right.
Why would I tie up my money? Why would I put it in a deposit account at a bank that might want to pay me 3%? And there's a little bit of a competitive battle going on there right now as to, who's going to offer what for money markets. And the banks seem to open up these narrow windows. They clearly are having, very targeted raises where they'll say, okay, bring new money into us and we'll give you a 5% money market for, guaranteed for a year or something like that. But that lasts for like 6 days and then the window closes and then they're back to 3%. Well, why would I even mess with that? If I can just take my money and throw it in a treasury, a 3-month treasury, if I know I don't need it for the next 3 months, it's not exactly a loan commitment. So I pull that money out of the bank, I throw it into a treasury, and now the bank has just lost yet more liquidity. So all that's coming together at the same time and crippling a lot of these banks. I mean, that's
yeah. And then the other thing you're hearing a lot about, right, is like how real is, the potential. I don't want to over dramatize, but hey, we're on a podcast, so we'll over dramatize, like the potential Armageddon of all of this massive commercial real estate debt that's coming due on, office towers, right, that have, lost significant value, right? That's just one asset class that everyone's sort of hyper focused on because, historically those are some big money assets with a lot of debt out there. And now all of a sudden you've got, these loans coming up and, a lot of these assets have dropped significantly in value and they're generating a lot less cash flow. Where is this going, towards, the second half of this year and into next? And how real a problem and what level of trickle down is that going to have, in your opinion, on the rest of the real estate market?
Well, I think we're in for a lot of pain over the next 12 to 18 months. I think that, and I think you're spot on. I mean, office, gosh, I would be very distressed if I were long on office. That is a very tough asset class right now. I just heard yesterday about a deal falling apart on a very high net worth investor who had a partner to come into a deal that was going to be a single tenant office deal, and the tenant was backing off, and then the equity partner pulled out entirely. The whole deal cratered. And that was for single tenant. I mean, if I were going to be in office right now, the only place I'd be comfortable would be single tenant, as long as I had a good credit tenant on the other side of it.
Right.
Obviously, we're still seeing as a sequela of COVID that work from home is now very, very much a part of the mix. It may not be sort of the permanent norm, but I think it's permanently a part of the overall work-life balance that people are looking for. And I think we're going to continue to see more people working from home, not necessarily full time, but for part time. More.
I mean, I think it's 100%. I've said that for the better part of the past year and a half. Is the work from home thing will survive COVID on some level, right? To your point, it might be hybrid versus fully remote, and obviously some companies are saying they want everyone in office all the time, and it varies from industry to industry and company to company. But at the end of the day, I think a lot of companies saw that they can still operate and cut overhead significantly by having people remote. And, that sort of is obviously a microcosm of what's happening on a macro level with the office market. But I guess along those lines, like, what asset classes right now are easier or harder for you to get deals done on, and just kind of walk our audience through, like, if I'm a multifamily developer and I'm looking to finance, a 30-unit apartment deal or a 300-unit apartment deal or a 30-unit condo deal, if that's even possible right now, right? Like, what do those kind of anecdotes look like right now, and where are you bringing those to the market, and what sort of difference in LTVs and LTCs are there now on these types of projects than there was before, and how is that impacting what you're able to find for your clients?
Yeah, so I'm going to answer that question, and then I'm going to tell you that if you ask me the same question tomorrow, I might have a different answer. I mean, that's how fast the market.
That's the best out you can have, though.
Yeah, that's how fast the market is moving. I'll give you an example. So every February, there's the Mortgage Bankers Conference out in San Diego, and I'm part of a national group of boutique mortgage banking shops called CRECA, which is Commercial Real Estate Capital Advisors. There are 10 of us. We do about $1.5 billion a year in total transaction volume in the CRE space. And we always gather together out there. We get a suite or a tent or whatever, and we'll host. I think this year we hosted about 45 meetings in the tent, 45 different lenders, capital sources of various shapes, sizes, types, et cetera. And at that time, the sort of prevailing consensus coming out of that was that the first half of the year was going to be a little thin on volume, but the second half of the year was going to be very robust. And lenders, one of the nice things about the timing of that conference, which is not coincidental, is that lenders use that to announce what their goals are for the year in terms of lending volume. And a measure that we at CRECA, that I certainly use, is comparing what lenders say from one February to the next. Obviously, last year as rates spiked, lending dropped off, and transaction volume dropped off sharply in the second half of the year.
Right.
So a lot of lenders, there were plenty of lenders who still made their goals, and that was because things were so robust in the first half of the year. And anybody that was concerned or had a looming refi need was trying to get things done as quickly as possible if they were well advised, seeing that rates were starting to tick up. So the first half of the year was heavily weighted. And then the second half, and one of the more prolific debt funds that I've done business with, is a debt fund out of the Midwest that didn't do, they made their bogey for the year. They hit their goal for the year, and they did not close a single loan after May 31st. So,
wow.
And that was kind of what the market was like. What was interesting was in February of this year, I thought for sure we were then going to see lenders coming in and saying, hey, our goal was $1 billion last year. Our goal was $3 billion last year, but this year it's going to be $750 million or it's $2 billion, right? I thought we'd see reductions in year over year goals to accommodate for the fact that we all seem to intuitively understand that the first half of the year was going to be a little bit thin on volume again. And instead what we saw was across the board lenders held to the same goals as what they had for 2022. And I thought that was really interesting. And, one of the things I came out of there saying and telling my clients was, if we have financing needs in the second half of this year, don't assume that it's going to be a standard, 45 to 60 days, because if all this volume is happening from, the basically September through December, we're not going to be able to get third parties in order to produce reports in the same sort of 3 to 4 week turnaround time. That's going to get stretched out to 6-7 weeks. And that means we're going to have our process extended out to, maybe more like 75 to 90 days. But all of that said, here we are now just a couple of months later, 3 months later, and I'm seeing, the lenders pulling back. So, banks putting pencils down and just saying, we're not open for business on lending. I'm seeing whole commercial real estate groups at some banks being told, don't go out and find us more loans, go out and find us more deposits. Which is an interesting thing to see that happen. And, friends of mine that are lenders at these different banks are saying, that's not what I do. I don't even know where to start on that, other than, just calling the Rolodex of existing borrowers they have and looking to try to raise additional deposits that way. But that's a major, major shift in 2.5-3 months. And so the picture for the second half of this year, I think, has gotten pretty grim. Which is hard. That's not my nature to say. I'm always a glass half full guy. And as a, you can relate as a broker, as an intermediary.
Yeah, totally. I mean, I remember lots of conversations over the fall and winter where everyone was kind of like, oh, the first half of the year is going to be a little rough, but as we get into Q3 and Q4, at least on the resi side, rates are going to normalize, and we're kind of going to be back in the around 5% on the resi interest rates, and it'll all be well and good. And a lot of what you're seeing that's kind of in the more commercial space that will obviously have impact on residential transactions and just the kind of landscape is that I think the general consensus is the second half of the year might not be as much of a kind of, in air quotes, recovery as kind of people had hoped.
Right.
Do you feel like that's fairly accurate?
Yeah, I think that's absolutely accurate. I don't think we're going to see a recovery in the second half of this year at this point. I mean, so it's we're coming up on 1:30 right now. The Fed is going to make its announcement in a half hour for this meeting. Expectations are a 25 bip increase. And as always is, the case is going to be, it's going to be more about what Powell has to say, than what they actually do. Now, if they don't increase, then that's going to be, that'll be taken as a very positive move. I think banks will breathe relief there, but it's going to be interesting to see, and are they going to say, okay, but now we're done? Right. I think
right. Well, I think that's kind of like along the lines of what I was just saying. I think if we were having this conversation last fall, I'd be like, oh, well, maybe we'll see another, they did the December one, and maybe we'll see one or two early next year. But I don't think anybody thought you'd be, on pins and needles for the Fed coming out in May and more increases would still be in the conversation. Right. I mean, I think everyone thought this would have subsided 90 days ago, 60 days ago, whatever. And so, look, I mean, that's kind of I guess, new reality, right? We are where we are. I think we're very lucky to be doing what we do where we do it, right? And that's trite, but, for our local audience, I mean, look, Boston's very insulated. We've still got a very strong market in many respects and far stronger than most other locales. But just, again, given the current challenges that we're talking about, how are you differentiating? What are you doing for your clients that, other people that do what you do may not be doing? And how are you able to sort of navigate through what are kind of rocky waters to get people's, goals accomplished here and continue to get some deal flow and enable, your clients to secure their capital to be able to execute on their projects?
Yeah, thanks. So I think a few things. One One is that I've always been a very sort of high touch client service person. So, I am, some of my competitors will kind of sign up an engagement, bring in the information, hand it off to a 20 something analyst, and then get a bunch of quotes, deliver them, say, okay, pick one and I'll see you at the closing. Right. That's never been how I've operated, whether it was for the first 16 years in this business with my former business partner or the last 4 years with my platform at Capital Stack CRE Finance. I'm constantly in the mix, advising my clients along the way. So I take the same approach when we're outside of that transaction environment for the clients as well. So right now it's really about communication. So it's talking to my clients in advance, knowing their portfolios, knowing what they have coming up, and having conversations about what I think things are going to look like. For example, I've got one client who's got a maturity in October, right? So I have been talking to him for several months, and frankly, coming out of the meeting, the MBA back in February, one of the first calls I made when getting back to Boston was to him to say, hey, we need to start this process now, right? This is, we may catch a break later on rates, but we need to get the process going now. Let's get everything lined up now. And just realizing and helping clients to understand the reality that if they are in bridge loans, or if they are in maturing, fully leveraged loans that maybe they did 5 years ago, 7 years ago, that were done at say 75% or even 80% LTV, that the reality is that with interest rates having doubled, that the cash flow that they're going to have in hand today is unlikely to cover a full refi without cash in. And as we said to start this off, that's an ugly word. Nobody wants to do a cash in refi. So then the next option is to get creative, and that's something that I've done really well for my career. I very much enjoy that part of this business. It's kind of the puzzle solving and thinking creatively with the clients to help them to address what the issues are, what the reality is in the world.
Yeah.
What the issues are that they may have, and then coming up with a creative solution to bring about a capital stack that solves for a cash neutral refi or acquisition. Well, obviously not acquisition, but refi in most cases. So that's fun. And that's what I've got one that, knock wood, is supposed to close this afternoon. That's a structured refi, and same situation. We were able to bring in a mezz lender to bring in a first mortgage lender that was comfortable with mezz, bring in the mezz to complete. The mezz is about 20% of the stack. And the first mortgage is at, sort of max proceeds, which 2 years ago, we'll put it this way. If we had rates from even just 1 year ago, this deal would be, or this post loan closing, this asset would be cash flowing at about a 1.6 debt service coverage ratio on its first mortgage, which would mean it would have plenty of room for that other 20%. Instead, we're going to close. He's got to hit some rent bumps to get to a 1.0 after closing. So, that's the impact of the rates. And rates are still at historically.
Well, that's the thing, right? Yeah. Yeah.
It's just that we got used to an environment of 3.5%. And that's nobody's fault. It's just a fact, right? And values adjusted around that. We haven't yet seen values adjust. I'm thankful for that. We're still seeing, very positive appraisals on multifam in this area. But at a certain point, if these rates stick around much longer, we're going to see some value adjustments as well. You just have to. You have to. You can't justify a 4% cap rate on an asset in a 6.5% borrowing market, right? that those two don't compute.
Yeah. So, I like what you said about just really kind of the puzzle solving and just, again, just kind of the resourcefulness of getting some deals done. What are kind of one or two cool examples of things you've encountered in your career where you're kind of really proud that you were able to keep a deal together or put a deal together and, just, some outside the box type stuff that people might not know even can happen. A couple of examples like that would be fun to hear about.
Sure. Well, if today's close, if you have me back on next week, I'll tell you about today's. One that was pretty interesting and probably the most structured financing I've ever been a part of was a multifamily asset in Providence back a few years ago now, where my client had some major cost overruns. This was pre-COVID, but major cost overruns during construction that had nothing to do with him. It was completely unforeseen. It was this I'd never heard of this before, but the steel for this tower, the steel was delivered and it was not cut to spec. So the units of steel were each about 3 inches, I think it was, short of what specs were. They got 5 or 6 stories in the air, and there was an adjacent building that they should have been essentially level with. And they realized at that point, wait a minute, why are we, obviously, visually a good foot, or I think it was like 18 inches below the adjacent building, which was kind of part of this development, but there was the existing building there. So when things weren't lining up 6 stories in the air, they said, well, what's happened? And then they measured and realized what had happened. So the project was shut down. They had a jerry-rig engineer in the field and get signed off on this engineering, a solution for that, so they could keep going without tearing the steel down. Because if they were starting over. And that would have just delayed, obviously, tremendous delay on the time, the ability to deliver. And
maybe some cost too.
Yeah, right. And he had a commitment on the delivery date. So it was a disaster for my poor client. And again, not of his own doing. It had nothing to do with anything he did or didn't do right. It was just, horrible misfortune. So end of the day, he was within a few months of finishing, and he had a $5 million overrun. But I met him actually on this project. So I was introduced to him by his attorney at that time, with whom I shared a lot of mutual clients and have always enjoyed a great working relationship. And anyway, so it was that attorney's client. He had recommended me. He said, look, you're in a real jam here. He didn't have the ability to write the $5 million check to right size the project. And so the attorney said, look, Brian's pretty good at creative solutions. Why don't we bring Brian in and see if he can solve this problem? So at the time, the stack was a bank first construction loan. There was some kind of a loan / grant from the city. There was a tax credit and a tax credit bridge loan. So the position that was available in the stack was at that time a fourth mortgage. The second and third mortgages were going to go away once the project was completed, and I think the tax credits had to fully vest, but those were going to eventually go away. But in the meantime, the position that we could offer to the marketplace was a fourth mortgage, which I had never even heard of a fourth mortgage before that. It's like who does that? And oh, by the way, it's in a stalled out. Well, not at that point. It had remobilized, but it was a yet to be completed construction project, which no lenders or investors want to come into somebody else's headache, right? Nobody wants to,
right, of course, yeah,
kind of restructuring of the capital stack in a construction project. But we were able to find, it was somebody that I knew through my CRECA network, where we had the year before, I think we had a group outing where we invited about 20 lenders and investors to come join all the CRECA offices and do some deep sea fishing. And it was one of the groups that had come along for that trip that I just had really hit it off with, and he was up for the ride. And
cool.
Ultimately, we got it done. A few years later, he was taken out of his position. Everybody was happy. So that was a tricky one that I hope I don't see another one that structured again. Right. We got it done. That wouldn't get done today. That I can promise you, that would not get done in today's market. We were fortunate. He had the misfortune of the steel issue, but he had the good fortune of it being probably somewhere around 2017, 2018, something like that, where everything was just go, go, go. And there was
right.
So,
yeah. So that's cool. That sounds like a pretty interesting one. So as we kind of get towards the end here and wind down, like what, I'm just trying to, as far as our audience goes, right? Like some real sort of micro specific examples, just so people can sort of wrap their head around some of the changes in the climate out there. If I came to you and wanted to build, a 50 unit development right now, how much more equity do I need than I would have needed, a year and a half ago? interest reserve, all that kind of stuff. Like, what are you seeing out there right now, and what advice would you give, especially younger developers, as they still want to kind of plow through and execute projects in this type of capital markets climate, on what to be prepared for as they look at deals?
Yeah, great question. So, capital is scarce. So, and leverage is down, and rates are up. So it's a bad combination. Yet we still have demand for more housing in this market, right? So it's going to make sense. I'm working with a client right now who just asked me about this. Just had this exact conversation a week ago, and he has an option on his land. And what I said was, the reality is that land is not worth as much today as it was when you optioned it a year ago. And they're through their approvals, but that's just the reality. And I said, I think you're going to have to work with your land seller to figure out a solution. Now, maybe that land seller can participate in some way. Maybe they don't have to discount the price. Maybe, there's some creative solution there that everybody can come out whole, but it's got to come down to change in land until and if costs start coming down. And right now we still haven't really seen a reduction in construction costs. So my advice to people would be, you've got to go in with more capital than you planned, where a year and a half ago, we might have been able to get a project done at 75, even 80% of cost, depending on what that appraisal looked like on stabilization. That's gone. Right now, we're looking at probably 60, 65% of cost. You'd be really, really hard pressed to get to 70. And part of the issue is if you look at where rents are, if you look at where costs are, and then you factor in what the cost of the capital is right now, there's very little value creation through ground up development. So we're not going to see a lot of ground up development over the next 12 months, 18 months, until either rates change or costs change. And one or the other has got to happen in order to inspire more ground up building. And I think we're going to see a pretty big pause on that. And it's a cycle. We've seen this before. That part of it, obviously, costs will start to come down when that happens, right? There'll be, as demand on materials wanes, then we're going to see those materials costs come down. And I think part of this is what the Fed wants, right? They wanted to slow down the economy. They wanted to take pressure off of commodities, off of materials, off of pricing in general, to bring down inflation. And I think that's what we're going to see, for better or worse. It's not not the news that you or I want, but it's reality. What I would say, I think it's a great time to lean into permitting, right? So if you have an opportunity to option land now, and you're, and it's Greater Boston, so you're probably 2 years away from having all your approvals, or 18 months away from having all your approvals. I think it's a great time for that. I think those who are just getting their approvals, have approvals in hand, and were thinking they were going to break ground this summer, for example, that's a tough spot.
Agreed.
It's not that it can't be done. It can be. I can still finance it. I am still financing that for folks. I mean, for some people, it's, hey, we're builders, we're developers. This is what we do. We're going to do it in good times. We're going to do it in bad times. We're just going to keep on going. And we can still make those work, but they're far less attractive. And the reality is you've got to bring more cash in. The other part of it is that you've got to have a strong balance sheet. Lenders are up and down and all across the capital market space. Lenders are going to be, or are, much more critical of sponsors, of their balance sheets. They want to see more liquidity than they were requiring. They want to see net worth. They're going to challenge net worth a little bit more. They're going to challenge, what values people are carrying on their personal financial statements for their assets, and have some, there are going to be some difficult conversations around, well, you're carrying this at a 4 cap. Do you really think it's a 4 cap? Shouldn't this be a 5 in today's market, et cetera, et cetera.
Right.
So those things are going to shift. And that's already starting to happen. And then last but not least is that it's just everything costs more in terms of the rate that you're paying. So, debt is more expensive at the most conservative and conventional places, the banks. And with that, the cost of capital from debt funds, private lenders, life cos too, which are they're the most conservative, but all of those across all of the various classes of available debt out there, everything's more expensive. So I'm seeing deals go off right now at 10 and 11% where clients are thrilled. Where if I had suggested 10% to somebody a year ago, they would have shot me, right? So now all of a sudden it's like, oh my God, I can't believe you got that done, Brian. That's amazing. 10%, that's a good deal. And I can't get my arms around that yet. But that's the reality, that if you're trying to get a full leverage construction loan, so if you want to get to 75, 80% loan to cost right now, you probably are paying 10, 11%.
Right.
Because it's not coming from a bank. But even banks are probably going to be, and I haven't quoted too many bank construction loans recently. I've got one that was just committed last week. That's a 40% LTC at 7%. 7.15. And that's 40% LTC. So, right. I mean, that's crazy, right? Compared to the environment we've come out of almost for 15 years, right? The last 13 years, we've seen incredibly low rates, and we've seen, high leverage because the numbers supported it. One more thing I'll throw out there is that lenders in general in the multifamily space will tend to kind of follow the agencies. So Fannie, Freddie, HUD.
Yeah.
And Fannie has been very clear that they are going to start tightening their policies in June. So if somebody's got a looming refi on a multifam, call me, call whatever mortgage banker you work with, call your bank, whatever it is. But you want to look at that now, because if you can get in with and get your file open with Fannie, Freddie in the next 4 to 6 weeks before they change, your deal will actually be grandfathered in. Typically, guaranteed grandfathered in as to what their parameters are today, and as their underwriting criteria tightens in mid to late June, which they may not, but they're indicating they're going to, then you may have a very different set of terms. And so that's just another piece, and lenders follow that, right? So as they look to, banks follow the guidance of Fannie, Freddie. And part of that's just competition. They're saying, all right, well, we don't have to do any more than what they're doing, right? So then it's, okay, they're pulling back, well, then we're going to pull back, and vice versa. So, that's another piece of this whole big capital puzzle.
All right. Well, let's kind of wrap it up here. Where's your business going? What do you see in a year, 3, 5 years for for Capital Stack CRE?
Well, I think for the rest of this year, knock wood, I think it's going to be actually a fairly robust year for me. I've got it, and it's just where my clients are and what their needs are. And we have a lot of refi in the pipeline, some acquisitions, but a lot of refinancing that just has to happen.
Right.
And sadly, they're going to pay a little bit more for it than what they have been, or a lot more than what they have been. Looking at maybe some shorter terms for clients, thinking that in 3 years out, that rates could be quite a bit lower than where they are right now. And so a lot of clients are interested in that. So I think the next 12 months, it's going to be challenging. It's somewhat exciting and sometimes fun, but there's going to be there'll be a lot of stress in there too. And I think in terms of volume, it'll be strong. Looking into next year, my guess would be that the first half of 2024 is going to be slim pickings. I think transaction volume will be down again at that point. And then probably ticking back up by the second half of that. So for me, I'm plus or minus whatever, 150 million or something like that a year in transaction volume. And I think for Capital Stack, that'll continue. As my clients grow, I grow with them. As their average transaction size grows, so then therefore does mine. And I think that'll continue. I think my clients are all going to weather the storm fine. There'll be some pain. But I think they'll all maintain their portfolios and get through it okay.
Yeah. All right. What's something people might not know about you?
Oh, something people might not know about me. I'll throw out two things. I actually grew up in Indiana. I was from here, but grew up in Indiana. So that might surprise a lot of people.
Okay. I didn't even know that.
So there you go. We've known each other for 25 years. Yeah. First grade through 8th grade in Indiana. So that's a little known fact. And played college baseball. So not everybody might know that.
Division I college baseball.
Yes, it was.
I mean, you wouldn't know it, with the dirty baseball guy with the handkerchief like that. I mean, show the hanky. You got to show the hanky off for that. That's your signature. I like it. Always styling. I
don't carry my glove around with me.
No. And your son's a real good baseball player.
He's pretty good. He's competitive.
Yep. There you go. Awesome. All right. Well, really appreciate you jumping on here. Guess last question is, what's the best book you've read of late, and any recommendations for the audience?
Oh, great one. So I just read, and I don't think I'd ever finished it many years ago. I'd read part of it, but I just reread or finally read the whole thing, the autobiography of Malcolm X, which was amazing.
Oh, really? Okay.
Amazing. Loved it. I'm reading The Color of Law right now, which is a very interesting read as well. And then, what is The Ascent of Money. The Ascent of Money by Niles Ferguson, he is a Harvard professor, he was, and it is a great book about the history of currency globally. Okay. But it reads like a novel. It sounds like, oh my God, shoot me. I can't imagine anything more boring than reading about that. It reads like a novel. It's brilliantly written, and you will learn a ton. So that's one of my favorite books of all time.
All right. Awesome. Well, there you go. Some good recommendations. So I guess we'll put a bow on it there, but just again want to thank Brian Sheehan, principal of Capital Stack Commercial Real Estate Finance, for joining us today, and we will catch you next time on another episode of Empowered Returns.
Thanks a lot, PT.
Thanks, Brian.
Thank you for listening to another episode of Empowered Returns. If you're a forward-thinking real estate investor or developer looking for actionable advice that will help you generate market-beating returns, make sure to subscribe on Apple Podcasts, Spotify, or wherever you get your podcast fix. I'm Mike DeMello with CHARLESGATE, and I'd love to connect on LinkedIn and further the conversation for any specific questions you may have. Thank you for listening.